Hello fellow investor, in this video I'm going to show you how to sell a covered call with Interactive Broker. First I will explain what a covered call is, after I will sell a covered call on my Starbucks stock in the trader workstation, and at the end I will reply to the 5 most asked questions about covered call. So let's begin. A covered call is a strategy when you sell a call option on a stock you already own. Basically, in exchange of a premium, you give the buyer the right to buy the stock at a fixed price. If the stock price goes up, you will be forced to sell the stock. But if the price goes down or remain flat, you will keep the premium, keep the stock, and you will repeat the process. It's a little complicated, don't worry, because now I will explain it with some charts. For this example, I'm going to use Starbucks. As you can see right here, let's say that this is the price chart of Starbucks. Today the stock is trading at 100 and you buy the stock, so your cost basis is 100. You want now to sell a covered call on this stock, so you need to decide first of all a strike price, which in this case let's say 100.05, just a 5% out of the money, and at the same time you need to decide an expire date for your call option. Let's say 1st September 2023. This is quite a long time, honestly, it's a little bit too far, but it's just an example. When you decide the strike price and expire date, you can try to sell this call off the market, and let's say you find a buyer that will pay you the premium of $1 to buy this option. Now in front of you there are 2 different scenarios from today up to the expire date, which is 1st of September. First scenario is a bull market. It's a moment where the price of Starbucks at the expire date will be much higher than your strike price. For example, in this case 120. What will happen in this case? The holder of the option will come back to you and will pretend you to sell the stock you have it, so Starbucks stock, at 105 instead of the market price of 120. So basically for you, you will have a gain of $5 because your cost basis was 100 and you will be forced to sell at 105. But unfortunately you will have also a missed gain of $15 because at the moment the stock is trading at 120 and you are forced to sell at 105. So if you didn't sell this call at the time I was recording the video, you just keep the stock until 1st of September, you will be able to sell at 120. But now, just because you wanted that premium, that $1, you will have the possibility to lose 15 in potential gain. This is the first scenario, let's say, is a bull market, but can happen also exactly the opposite. Let's go back at this situation. You just get the $1 premium and you will have a bear market. So the stock price of Starbucks from here up to September 2023 will be lower than the strike price on 105 and even lower than 100, which is your cost basis. In this case, we say that the option expires worthless because the holder of the option, the buyer, have no interest to come to you and buy the stock for 105 when he can just find the 490 on the market. So you will keep the premium, the $1 that you get at the beginning. You will keep the stock that, of course, it lost in value, and this is another type of problem. And you can just repeat the operation with a new strike price and a new expiring date. I hope it is clear. I will now switch to the trader workstation of Interactive Broker and I will do a live selling of a covered call exactly on Starbucks. So this is my Interactive Broker dashboard. As you can see on the right, we have my dividend portfolio right here. Let's go in now to select Starbucks. See on top left it appears that have 220 as a position. This is a stock I have, and let's click on option chain. Option chain gives us the idea of all the options we can buy or sell related to Starbucks. Let's go to see on top right here. You can see that there is the expiration day at 7 days, 14 days, 21 days, or so on. We can decide the one we want. In the example I did before, I put 1st of September, but this is not a very nice strategy. I prefer to sell covered call more like within 20 days, 1 month. So for this reason I select 21 of March. Strike price 105. You see right here we have the bid and the ask. 1.14 is the price asked to sell the call, 0.89 is the price to buy. So in this case let's mark at 0.9, 1 covered call. It means this is important as well. Every time you see covered call, you need to understand that when we talk about 1, it means 100 share. So we sell a covered call on 100 share. The fee we saw like 0.89 need to be multiplied by 100. In this case, I have 220 share of Starbucks, but I will sell only a covered call on 100 of them. So quantity 1, the price, let's put 89, and let's click to submit. We see right here all the information about the full amount I will get as a premium is $89 if we will sell at 0.89, so 100 share 0.89 is $89. The commission is expected to be between 0.62 to $1.55. This is a full commission, not per share. So at the end, it tells us approximately we'll get a net premium of 87.91. So let's go to transmit, and we see that it's already sold. We sold at 1.05, which is good, so we get more than expected. And we see in portfolio right here, this, if we click on it, this is the Starbucks covered call I sold. On the left there is the chart, so let me zoom it. This is our entry point at 1.05. Now we need just to wait until expiration date. If the price would be higher, we will sell the stock at 105, but comparing to my example before, that my base price was 100, in real, as you can see right here, my average cost on Starbucks is $80, so I will have quite a nice capital gain. If the price will be lower than 105, I will keep the stock, and I will keep, of course, my premium. I hope you get an idea of how everything works, both theoretically and also in practical way, because I showed you how to sell directly on the trader workstation. I will now try to reply at the 5 most common questions that I got asked about covered calls. Can I sell a covered call if I don't own the stock? You can sell a call if you don't own the stock, but this will not be called a covered call, because covered means that you own the stock. It will be called a naked call. To do it, you need first of all a margin account on Interactive Broker or in whatever broker you are using. And you need to remember this is much more risky, because if we go back at the previous slide right here, we see that in this case you are forced to sell a stock of Starbucks at 105 to the holder of the call. But you don't own the stock. It means you need to go on the market, pay $120, and after sell it at 105. So you will not have a missed gain of $15. You will have exactly a loss of $15. You don't know how high this price can be in 6 months. What if it will be 200, 250? You will lose a big amount of money. Covered call are called in this way because you own the stock already. So if will be necessary to sell it because the strike price will be triggered, you already own the stock, you know how much you paid for the stock, you will not need to put other money on top. So keep in mind that selling a naked call is much more risky. How to choose the best strike price and expiration date. This is a little bit tricky. There is no better choice you can do. There are just different choices. In general, the higher the strike price, the smaller will be the premium that you get from the buyer, because it will be much more difficult that the stock will rise over the strike price. So in this case, we saw, for example, we did just a 5% out of the money, but if instead of 105 we will put like, I don't know, 130, it will be probably much lower premium. From the other side, the expire date works differently. The longer and the farthest is in time the expire date, the bigger will be the premium, because the market will be uncertain in 6 months, 1 year or something like that, because you can sell call very far away in the time. From the other side, the shorter the expire date, the lower the premium you will get. So you need to find a combination of these two. You need to understand which kind of risk you want. If you want a very high premium, you will be forced to have a very low strike price or very long in time. From the other side, if you don't want to lose your stock and you want to be a little bit more prudential, you need to have a much higher strike price and probably a shorter expire date, but in that case the premium will not be so high. You need to find something that balances with your style of risk. Can I sell a covered call of any stocks or ETF? No, you cannot, because not all stocks and ETFs are available on the option market, but let's say that basically all the mainstream stock that come from the S&P 500 and the most common ETFs you can find out there, they have an option market. If you go looking for some penny stock, most probably you will not find the possibility to sell a covered call, but in general you cannot trade option on them. Should I pay taxes on the premium I receive? Yes, of course, depending from your country. The premium is treated like a short-term capital gain. So if in your country you need to pay taxes on short-term capital gain, yes, you will pay taxes on the premium. For me or for anyone that is a resident in the UAE, zero taxes, so the premium will be just net cash in for us. What is the biggest mistake to avoid? Before to reply to the last question, if you arrived up to here, please subscribe to the channel because it really helps a lot what I'm doing right now. The biggest mistake in my opinion is selling a covered call with an expiry date which is close to the date when the company have earning report. It happened 4 times a year that the company published the earning report, and during this time in general stocks are much more volatile. And because the goal of this strategy, the whole goal of selling covered call on your dividend portfolio, in general your portfolio, is not to get the call exercise. You want that expire worthless. So if you sell it too close to earning report and you get a big jump in price, you risk to lose your stock. Doesn't mean you lose money, as I said before, maybe you will have your gain, like in my case the $5, but for me I really hate when one of my stock got sold, so I really try to avoid this at all. I hope in this video I was able to explain clearly enough what is a covered call and how it works. Anyway, there is much more I can say about covered call. If this video will perform good, will have enough likes or views, I will probably make another video where I enter a little bit too much into how to select the strike price. I will introduce the concept of the Greeks, and I will talk about an option rollover, which is a little trick not to lose your stock even in case the strike price is triggered. Anyway, that's all for this video. If you have any question about what I said right here, please leave it a comment because I always reply, and see you to the next video.